Zacc, thank you so much for being here. You created a Social Security Taxability worksheet that is, in my opinion, one of the best in the world. I mean, we have people asking for this.
That's ambitious.
But there are tens of thousands of people who have downloaded it. Now, it can be very complex, and we want to make it simple for those who are trying to figure out how much of my income from Social Security would be taxable, but also how does the new One Big Beautiful Bill Act impact these calculations, because these calculations impact other calculations that are going on here. So we've got this worksheet, and I kind of want to contextually think of this as, if somebody has downloaded this, how do they use this effectively?
Got it. And I'm going to do my very best to dive right into the sheet because that's what people want on YouTube. And then after we've shown you how to use it, it's really important that you listen to a little bit more because the bill is not clear. There's verbiage in the bill that alludes to it will show up this way or it will show up that way, and it's not designed, it's not done. So it's something we have to wait and see, and we'll make adaptations as we go.
Yeah, perfect. And for anybody who downloads this spreadsheet, we do update it. And as we have major updates, you will get another copy as long as you downloaded it.
I think we've updated it 5 times in the last 24 hours.
Yeah.
So
and for each year, there will be things we talk about that are not applicable this year that will next year. So next year it will be implemented.
Okay. So let's throw in some numbers and then give it a go.
That'd be great.
Okay. So I'm going to throw in, we've got a joint couple that they're both over 65. And the reason for that is the biggest question mark in the big beautiful bill around how it's going to impact Social Security is the senior deduction. We were all told that was to make it so Social Security wasn't taxable. Instead of just saying we're just going to make Social Security not taxable, they basically threw a deduction in there that they hoped would offset taxability of Social Security. But let's look at it, because we'll do somebody over 65 and then let's flip it for under 65.
Perfect.
And do the exact same thing. So 25,000 of AGI, 50,000 of Social Security. I'm actually going to make this 60 because it will make it easier on our eyes to see what's going on here.
I'll just interject here for those who are using this spreadsheet as a tutorial. AGI, not including Social Security income, what inputs generally would go in there?
You can get it directly from the tax return. I'm just trying not to make people know all the lines of the tax return.
But wages, salary, IRA distributions, there are others, but just high level. For most people, that's going there. Tax-exempt interest income.
That gets added. Tax-exempt interest is the next box down.
Perfect. Yep. And that would include generally municipal bonds. There are others.
That's the main one, though. Yeah. People buy municipal bonds. It's a type of bond. It's a type of investment that you get interest that's tax-free. And the government's saying, hey, we don't want a bunch of super high-income people who get this tax-free income to also get their Social Security tax-free because they do that.
Perfect.
So they throw that back in. It's going to be the first about 7 or so lines of the 1040 tax return.
Perfect.
Almost all of that stuff gets added in. And then on top of that, they throw in the tax-exempt interest, so that's on top of what gets added into the 1040 1 through 7. And then Roth distributions, if you do them correctly, again, there's going to be exceptions, but generally a senior who's done the Roth distributions the right way, that does not show up in these income amounts. So as we're going through these income numbers and how to use this spreadsheet, that's just a general idea of what's going where. Yeah, and we've had a couple questions on the new charitable deduction, the one that is not part of the itemized and standard deductions. And I feel bad, Eric. You tell me if I need to dig deeper, because we're just throwing concepts at itemized charitable deductions and before and all this stuff. And if you tell me we need to dive deeper, let me know. But bottom line is the AGI, not including Social Security on this spreadsheet, if you make, for a couple in this case, up to $2,000 worth of charitable contributions, and you're using that as an above the line deduction or before AGI deduction, you need to subtract that from that cell. And there's a note right here that says that at the very top.
Starts in 2026. So for 2025, doesn't apply to you yet.
Yeah, there's a number for 2025. It's just smaller.
Yeah.
Okay, so if this couple having $25,000 of regular income that's not Social Security, and then $60,000 of Social Security, which it does happen. I know some people will say $60,000 of Social Security. It happens if somebody has a $3,000 benefit and the spouse has a $2,000 benefit. There we are. Yeah. Okay. So if this person gives to charities, there is now an ability to give up, if this couple can give up to $2,000 and have that erased from their income before we're even talking about itemized and standard deductions. Normally, charitable giving is only beneficial to you if you itemize your deductions later in the tax return process. But in this case, if you do a standard deduction, you can take up to $2,000. That's in 2026. Right now, it's like $300 and $600 for individual and couple. Mm-hmm. So no matter what the number is, if you're doing the 2025 numbers or if you're looking forward at 2026 and you're looking at the 1,000 and 2,000 for individual and joint, just subtract it from this box where it says AGI not including Social Security, because that's what's happening with that charitable adjustment. It's happening early in the process.
Perfect.
So you subtract it. Let's say they are. So let's say they take a standard deduction and they're eligible to take this $2,000. We're modeling out what would happen in 2026 for this person. And they are able to subtract $2,000 out of their adjusted gross income. So they're at $23,000. And then $60,000 of Social Security. The way that whole calculation works is you've got a couple parts that lead into two calculations. You take the lesser of the two, and in this case, the lesser of the two is $13,650. That's the amount of their $60,000 that they must include on their tax return, and that's line 6. So on line 6 of 1040, they have you put all your Social Security benefits, and then they say, but what's the taxable portion? In this case, this couple is going to put in box 6A, they're going to put $60,000, but in box 6B, which is the one that matters, they're going to put in $13,650, which is fantastic. Here you have a couple with $83,000 of income, and they have a taxable income way less because it's $13,000 from Social Security plus $23,000, so $36,000 total. And here's where it starts to get really tricky because they have a $34,700 total standard deduction because there's a regular standard deduction plus standard deductions because they're over 65. And that's how we get to the $34,700. But now there's a huge question mark. There's another $12,000 additional senior deduction associated with supposedly erasing the taxes on Social Security, which in this case it does. It does because what's happening here is they get to deduct another $12,000 and their income is zero. This couple has $83,000 of cash flow with zero reportable taxable income. Pretty great. If they take any additional income, they'll probably, because they didn't get to use all the 12. This was a question you and I talked about earlier. Yeah. I think somebody may have asked you. In this case, they actually didn't get to use all 12,000. It doesn't go in reverse. The government's not going to credit you back. It's
pay you more money because you were at a level where the 12,000 puts you as a net negative.
It's use it or lose it.
Okay.
There are what's called refundable credits and non-refundable credits and deductions. I'm not sure. I don't know of a deduction that is refundable. All deductions are non-refundable as far as I know. But credits can be. This is not a credit. This is a deduction. All right. So I'm going to pause for just a moment because there's a key concept that people must understand about what's going on here, which is in the bill itself, it uses two different types of language that hint at those two different pieces of language hint at where on the 1040 this is going to slot in. And the language is either this is the eligibility for this deduction is based on adjusted gross income or modified adjusted gross income. When it says it's based on AGI, that tells us that it is something that happens later than the AGI line in the tax return. If it is something that says is used in determining AGI, then it typically happens before AGI in the tax return. The Social Security calculation that we're in right now also happens before AGI. So there's 3 spots that this $12,000 senior deduction could land, and the bill isn't clear enough for us to know.
Mm-hmm.
So we're somewhat waiting on the actual tax return to come out so we can look at each box and the instructions on the sheets to say this is what they determined. It's basically the architect is done designing it. They didn't put enough instructions in, and they're basically like, contractor, you figure it out. Mm-hmm. And the contracting work has not started yet around how do we interpret this language and put it into the forms. So here are the 3 spots this could land. If this senior deduction happens before the Social Security calculation, then it would reduce people's taxability of Social Security. Let's throw another situation in that will affect that. So I'm going to throw $50,000 of other income in here. This $50,000 of other income makes it so that they have 61% of their Social Security showing up on their tax return. If it happens, if this adjustment happens early enough before this Social Security calculation, then let's take it down, and they have 12,000, let's take this down to 38. Now that changed it from 61% down to 44%. So they are looking at 36,600 of their Social Security showing up, or 26,400 of their Social Security showing up. That changes their tax bill by quite a bit. So it goes from 4,000 to 1,700. So that's a $3,000 tax difference in their tax bill if that happens there at that spot. Okay, the natural interpretation. This is if I had to interpret it and say based on these words, where is it happening? It's happening in what's called Schedule 1, Part 2. Mm-hmm. So if it says that it is used in determining AGI and it is an adjustment to income, which is basically what this is, I would predict that they're going to throw it on Schedule 1, Part 2, which happens just after Social Security eligibility, but that's one thing they pull into this tool. So you'll see it there's a box for it that says Schedule 1, Part 2 adjustments. So if we throw that in there, it does the same thing. If it's a Schedule 1, Part 2 adjustment, it will take this person's tax bill down in the same way. So that's spot 2. Mm-hmm. It does. In this case, it didn't change it. Spot 3, however, is after AGI and part of the deduction process. And this is the hard part. If you put this in Schedule 1, Part 2 adjustments, then you throw that $12,000 in as an adjustment. Well, that changes how much of their Social Security shows up. Eligibility for this $12,000 is based on your AGI. So the $12,000 reduced your AGI, and your AGI being reduced maybe makes you eligible for more of the senior deduction, which reduces your AGI, which sends you back in this loop for over and over again. And if you've done any work in Excel, when you do a formula like that in Excel, the thing stops and says, this is a circular formula, you got to fix it. Mm-hmm. So it doesn't work. You can't have this dependent upon this and this back dependent on the same thing. Bottom line is, it's impossible to put it in that way without some really complex algorithmic math that circles until it reaches a limit, which is not going to happen. They're not going to require computer processing like that on the tax return. They're going to do it so that if somebody wanted to do their tax return by hand, they could. So there's still clarity that's needed. The way we've built the Excel file is actually to put it after, because there's no way for us to know if you're eligible for the deduction at all unless we figure out first what your AGI is, without letting the senior deduction impact your AGI.
Because the eligibility for using this deduction is based on income. So those with higher incomes get phased out of this deduction.
Yeah. Let's look at that exactly now. So the way we've built it is to show, in summary, let me be really clear. Using our tool as it stands today, there is a flaw in the clarity of the bill that forces us to make a decision on how we're building this tool, and we'll update it as soon as we get clarity. But the decision we made, and it's backed by some other national tax software providers that we get into the back end and be like, how are you handling this? Most people are handling it as an adjustment or deduction that happens after adjusted gross income,
Okay.
which means that it's not going to change how we're calculating your Social Security taxability today.
Mm-hmm.
But the bills kind of alludes to the fact that it should.
Mm-hmm.
But they've got a circular formula. We'll wait for them to figure that out. Okay, so with that being said, let's say you have this $25,000 of AGI and $60,000 of Social Security. Now, in previous videos, we've talked about something called the tax torpedo, which is as you add income, because of the additional income, the Social Security calculation, like it drags Social Security income into the process and it spins it all together and you're caught up in the whirlwind of it. And basically $1,000 of Social Security here, $1,000 of regular income adds an additional almost $2,000 total because it pulls in another $900 of Social Security. So as that goes up, that's something to be really aware of, but that's our other video. I'm going to throw in a higher number here.
You just changed the incremental addition of dollars is what Zacc just did. So some have said like, hey, it doesn't go, I want to add it to $75,000. And if the increment is $1,000, the table doesn't get that high. So you just add the incremental amount. And now for every $5,000 up that you add in additional non-Social Security income, that's what we're looking at.
Got it. So in this case, $5,000 of additional income causes $9,000 of additional total income because of it dragging in more Social Security. So this blue category here, I forget that people are able to see this while we're talking. Yeah. Sorry about that.
But another thing for that, right? If you're planning a trip or you want to buy a car or you want to do something with a home and you're pulling out additional income, I'm just trying to think of an example why somebody would pull this out.
Roth conversion is really the big one.
Roth conversion.
Because if you need it for life, do it.
Yeah.
You know what I mean? That's different. I think people, especially nerds like you and I, get so hung up on the numbers, the math, optimization, all of that, that it's really easy to forget that the most important thing is to have your money support your values and push the important things in life and relationships and all those things, right? So if it's for a vacation, don't look. You know what I mean? Do look, but don't stress about it. If it is a Roth conversion, well, that is a pure optimization conversation that has nothing to do with whether it really impacts your life that much. It doesn't send you on a vacation, maybe way later, but the point is you're optimizing the money. So that's the big one. If people do a Roth conversion of $5,000 in this case, thinking that they only had to pay taxes on the $5,000, that's a bad assumption. They're actually paying taxes on $9,300, and the tax cost of that is pretty high. I mean, that's not gonna be at their marginal rate, which their marginal rate they're thinking is 10%, but they're paying 10% on 9,000, not 10% on 5,000. Mm-hmm. So it's gonna push them up to about a 18% marginal rate on that conversion. Mm-hmm. So it's Roth conversions that really drive like the decision here, because again, life is different. You should be willing to pay taxes on your money to get it to enjoy life. Okay, so but from the nerdy math side, $5,000 is what I put in additional non-Social Security AGI as the incremental amount, and then the tool will just say, okay, we'll use 5,000 more on every row to show you what it looks like. And then this column U shows you that it's blue because it's saying we're in that zone where additional money pulls in more Social Security, and it goes gray at 85% because additional $5,000 here is not going to pull in any more Social Security. You're at the max of 85%. However, the senior deduction is the full deduction, in this case, all the way until they add about $75,000 of income. Once they have added 75 on top of the other income they have, then they'll start to lose some of their deduction. And in this case, it's $11,880, and we don't have it completely going away on this. We just changed the incremental amount up. If we wanted to have it completely go away, I'm going to put it at $7,500, and there we go. So we're seeing that we talked about $75,000. It starts to go away, and by time they reach $180,000 of income, additional income, it's gone. It goes down by 6%. And be careful. Eric and I we spent like an hour on this yesterday.
Yeah.
We got lost in the bill going through every little nitty gritty detail. If you're a couple, it's 6% of each of your benefits, not just 6% of every dollar towards the $12,000.
Right.
And depending on how you do the math, it could extend how much over how long this thing lasts for you as you add additional income. Okay, Eric, help me out here. Those are the two like phase outs that people need to understand. That there's a portion of the scale where adding income adds Social Security, and then there's this spot where neither happen. Your Social Security is not impacted, and the senior deduction isn't impacted. And then after that, you start to lose your senior deduction. And the most important thing is, I know the bill says that the senior deduction can be used in determining AGI. The bill also says that your AGI determines your eligibility for the senior deduction. So until that gets resolved, I don't know how to do it other than put it at the end. This is the conservative way of doing it. It only could be better than this. Let's put it that way. It's going to be this or better for you.
Perfect. One thing that I think is really important with this senior deduction is we're talking about Social Security and this potentially lowering your Social Security, but this senior deduction has nothing to do with you actually taking Social Security at this moment in time. It has everything to do with your age. So if you are 65 or older, then you have access to this senior deduction. If you are younger than 65, you don't. So there are people who are taking Social Security benefits before 65. You don't get this until you turn 65. There are others who are 65 and older who are not taking Social Security benefits. You still have access to this deduction with another asterisk around your income, which you showed with the phase out.
Right. And if you do an itemized deduction, or if you do larger amounts or whatever, you can come in here to the deduction column and type in whatever you want. And I mean, it'll break the formula, so maybe don't save that version or save a blank copy. But you can type in whatever you want, and it'll tell you roughly what the taxable income is for that situation.
And you get to use this deduction whether you itemize or you take the standard deduction.
Right. That's a good clarifying. So when we're talking about itemizing and standard, we're talking about everything else, not the senior deduction. It's not part of that calculation. It's on top of. But I just changed it to show joint couple 1 over 1 under, and it now reduces the additional senior deduction to $6,000. This person is in such a good spot. $85,000 of income with a taxable income of $1,250. Their tax rate is 0.1% on their income. They have to pay $125 in taxes per year federally. I mean, that's pretty amazing.
Maybe you can describe what's going on in this middle section here with the gray table, what you were just referring to in this table and the one below it.
Okay, so these are the tax brackets. And they call them marginal because it's what's called on the margin, or the next section of income. Your first, well, you even alluded to this in your other video, there's kind of a 0% tax bracket. It's your standard deduction or itemized deductions and senior deduction. All of that's taxed at 0 because they just let you erase it. But once you've erased that amount of income, the rest goes through this grid. And it's 10% on the first $23,000 for a joint couple, then 12%, then 22%. Now, for example, for the 12% tax bracket, it's the amount between $23,000 and $96,000, not 0 to $96,000. That's the biggest mistake people make and I think most of your listeners are pretty familiar with that, so we don't need to pound that one in. But if you're a single person, then these numbers are not exactly always cut in half, but pretty close. So it's your first $12,000 is in the 12 or in the 10% bracket, and then from 12 to 48 is in the 12. So what's happening is after you take your Social Security taxability and your other income, and you come together and you get, this is my adjusted gross income, and then you get to take your deductions, and then you get to that number at the end, you throw it through that bracket, and that tells you exactly how much taxes you pay. So in this middle section, these are just helpful calculations so that you don't have to do all of that. It's telling you what is the standard deduction, what is your additional.
That's tied to your age and filing status that you put over on the left.
Yeah, so now we're looking at a single person. Same numbers, single person. Let's flip back and forth a little bit. So I had joint 1 over 1 under, and before it was you had to include 26% of Social Security. Because the Social Security phase-outs are a little bit different, the Social Security amount you have to include as a single person in this same situation is 37. Now, a single person's probably not going to have $60,000 of Social Security. So I'm going to change that to, let's say they waited and they got a really great benefit and enhanced it, and they're getting $4,000 a month or
I
something.
think the average is right around $2,000 a month or something like that. A little less than that, but
yeah, it's usually less than that. In the last several years, it's been between like 1,400 and 1,800, I think.
Yeah. So we're going big here just to kind of show numbers.
But you can go small; it doesn't matter. But if I put in $20,000 even, this person has to include 27%. But let's put in 36,000 just to kind of $3,000 benefit per month seems pretty reasonable for somebody who worked pretty hard and has had an income of $80,000 to $100,000. So here we go. These calculations are just super helpful. They tell you your standard deduction. They tell you the additional senior deduction. If you phase out of the senior deduction, this cell will figure that out for you.
Perfect.
So if it says $6,000 or $12,000, if you're a couple, both over 65, you're getting the full thing. And I keep throwing this asterisk up, with the assumption that we're throwing it after AGI because we can't figure out how the circular nature of it would work. And then it tells you your basic taxable income, estimated tax bill, effective rate. This person pays 2.2% of their income away in taxes. Not bad. Their marginal bracket is 12. Now, that's the literal marginal bracket. That's the spot they're in. That does not mean that if they take a Roth conversion of $7,500 that it's going to cost them 12%. It won't, because $7,500 is going to add 13.9. So it's really 12% on 13.9, and we're pulling out
$1,600, almost $1,700.
Yeah, exactly. So do that divided by 7.5. That's 22%. So even though they're in the 12% tax bracket, that conversion costs them 22. So that's the effect of taxable income and how that works out. But so don't read into marginal tax bracket as that's my marginal tax cost of any dollars that you add. That's the literal bracket in the federal return that you're in. And then how much room do they have in that bracket? $15,000. Now, to fill up that $15,000, they're actually going to fill it up with almost $7,500 of a Roth conversion because they're putting $14K in.
That second number is what you want to look at to compare to the room you have left in that bracket. That's a good clarifying thing.
Because if you do let's just do it right here and just pretend if you did a $15,000 Roth conversion here, you added $27,800 of income. So you filled up the bracket and then some. And 15 of it was taxed at 12, and the rest of it, the other 12,800, was taxed at 22. Multiply those two together, and that's your tax bill. And that's what it cost you to do a $15,000 conversion. So you take that tax bill, divide by 15,000, and you get your marginal cost, which in this case is going to be close to 20. Even though the conversion itself cost about 20, their overall tax bill is really not that bad when looking at the whole picture.
Yeah,
because it's still only $4,700. Anyway, okay, so one of your questions that we saw a lot on the video was, does this change my Roth conversion strategy? And the reality is, yes, it does, because it can allow you $6,000 more of income
for a single person.
For a single person, and 12 for a couple that are both over 65. So keep in mind, if you're a couple and one of you is over 65 and one is not, you're still 6,000, not 12,000. But anyway, this could allow you to convert that much more without having to pay taxes on it. However, it does not happen, at least in our calculation, and until we get further clarity, before Social Security. So that means that your $6,000 of space might be eaten up by a $4,000 conversion because it's throwing more Social Security in.
Yeah. And I think that this, one thing to consider is a lot of changes to this that are coming because of the One Big Beautiful Bill Act went from being temporary or expiring to permanent. What we are talking about right now with the senior bonus deduction is not permanent and is set to expire after 2028. So that means if you are considering some sort of a Roth conversion strategy, you have this 4-year window to take advantage of this deduction. But you made a point offline of there's a lot of things that were supposed to expire and scary for 2026 and eventually got pushed. So,
Yeah.
but the bill states that it is temporary, not permanent. But even when we're talking bills, permanent doesn't mean it will never change, and temporary doesn't mean that it is guaranteed to change.
Yeah, for the last 5 years, we have been saying and talking to people, hey, we don't know for sure. It depends on the government at the time in 2025 as to whether or not the tax cuts that were put in place will expire at the end of 2025. I mean, everything we had been saying was the 12% will be 15, the 22% will be 25, the 24 will be 28, and these lines will all change, and different. And there's so many little things that would have changed, but and we were thinking that way during the Biden administration because we didn't know who was going to win and what the House and Senate would look like during 2025, back in 21 and 22. So to your point, for the last 5 years, we've been saying the same thing you just said, which is, hey, the next 5 years are a Roth conversion opportunity to be thinking about these lower tax brackets. And now we have those lower tax brackets plus some additional deductions and little benefits here and there that maybe make it even more attractive for a little while.
Yeah.
And in general, a lot of these phase out for people with really high income, above $250,000 to $400,000. Each of these start to phase out and you lose them. I know that can be that's frustrating for a lot of people. They're like, oh, just the rich are benefiting from all this stuff. And the reality is a lot of this stuff is available for people under $250,000 of income and phases out. And again, we talked about that number offline a little bit. That's rich in some states and that's poor in other states. Not poor, but that's barely getting by in some the New York and some California places where they are having a hard time even thinking about buying a home if they make that kind of money.
I think that's a great point, Zacc. So the income, again, $250,000 for somebody living in a certain place could seem very high, but very low for others. So maybe let's go through the spreadsheet one more time with a little bit higher incomes, showing the Social Security taxability part of it.
Okay, let's say that we found somebody who saved really well. They have a lot of traditional IRA money. They take a lot of money out of their retirement accounts because they have big retirement accounts. Let's go back to joint for a minute. We were doing single for a little while there. A joint person, they have $60,000 of Social Security income, so $210,000 of total income. They are for sure past the point at which they're going to get any of the Social Security benefits of. They do get 15% of their Social Security back tax-free, but they're going to hit that max 85. Then they are going to they're going to phase out. They're in the phase out of the additional senior deduction. And depending on how much more income they take, AGI is supposed to impact their eligibility of the senior deduction. So it should take it down by 6% as they go over. That's pretty straightforward. You're going to see that on the far right of this Excel file. Oh, and if you're really trying to figure out all the numbers, on the far right, we threw in the various filing statuses, the tax brackets, different lines for them. We had to put a number at the very end for the top bracket. If you make more than $10 million, let's talk about other things because there are other issues for you. But that was the biggest number we threw in there. But it'll show you total income. It'll show you AGI and deductions. And by the way, this first cell is, I think it's conditionally formatted so that if you hit Medicare premium concerns, it goes red like this, which we'll see. We could test that out. Okay, so it shows you how much of the tax bill is associated with each tax bracket, and then the total tax bill of $25,000. All this stuff was there before, but we expanded it because you had a couple people that were like, "Hey, I don't see this or that."
Yeah. No, this is fantastic.
That's for a high income person. So a low income person is, because the phase outs are pretty high around this additional senior deduction. If you are in the space where you're making less than $60, $70, $80 to $100,000, your bigger concern is the Social Security taxability and how that will impact you. If you're in the space of 100, 150 to 250, you're probably beyond the Social Security tax torpedo. You're probably having to include 85%. And now we're talking about the senior deduction that is starting to phase out for you.
Can I ask you a question you may not want to answer?
Okay, go ahead.
If somebody's sole income is Social Security, odds are they're not going to have that additionally taxed. But also, do they even need to file a tax return if they don't have a tax bill, if we phrase it that way?
Oh, geez, interesting. You are supposed to file a tax return when you reach certain thresholds of income and they're extremely low.
Okay.
$1,000, $2,000, something like that. I can't remember what it is today. If you get Social Security income, you should file a tax return. Have you had people ask you about this?
Yeah.
Okay. That's my opinion. You should file a tax return because the government is getting a 1099, I think it's a G. So they are getting a tax form that says Mr. and Mrs. Smith received X amount of Social Security income. And it's on us to prove that we shouldn't be paying taxes on it. I know that's dumb, and you're going to have people that are going to be upset about that comment, but that's the way the rules work. Not the way they should work, maybe, but the way they work.
Yeah.
So the rules work that it's on all of us to prove what our tax bill is and be ready to be audited if we got the math wrong.
Yeah. And
so for a senior, you should file a tax return. Even though your tax bill, like I can show you, like in this case right here, $60,000 of Social Security, and they're all joint couple over 65. So they have the standard deduction, they have the additional senior deductions that are part of the standard deduction, and then they have this additional senior deduction that's brand new, this $12,000. And that wipes away all of because they don't have to show any of their Social Security anyway in the beginning. In fact, there's probably $40,000, maybe not. We'll see what the number shakes out. There's a number that they can take in regular income. I mean, this couple can have 20,000 plus. We could keep playing with it. Our advisors have a different version of this tool that has macros built into it and things, but that's not something. Macros are hard to send, and where we can say like, well, just optimize it. Boom, hit how much Roth conversions can I do, including the torpedo of taxes. How can I optimize a particular bracket? How can I get a zero tax rate entirely? Anyway, we tinker with it a lot. But this person here has $80,000 of income, $20,000 of adjusted gross income that's not from Social Security, and the couple doesn't pay any taxes at all. And that is a big Roth conversion strategy because you're going to have to take money out of your traditional IRA when you hit a certain age, between 73 and 75 right now. If you convert enough of it that those minimum distributions are small enough that they make it so your Social Security disappears, and now you can take these deductions, you might be able to have this kind of income of $50,000, $60,000, $70,000, $80,000, maybe more, with no tax bill for the rest of your life.
Yeah.
Now, kind of, because things can change.
Perfect.
Right?
I think this is a fantastic tutorial for those of you who have downloaded this, whether years ago or the most recent version today or in the future. And then another deduction that could come into this conversation if you're itemizing is the increase on state and local tax.
This one's huge.
Yeah.
This one's huge. Yes, because we've been up against this for years now. And $10,000 sounds like a lot of state and local income tax. And some people are like, oh, that's really wealthy if you have to pay $10,000. And well, property taxes in a lot of places on a normal home that people bought for $200,000 a decade or two ago now is maybe worth $800,000. And they could be easily paying $5,000 to $10,000 in property taxes. And then state income tax, just depending on your state of residence. So here in Utah, it's 5% roughly, plus property taxes. Those two regularly hit $10,000 and are capped out. So if somebody's making $200,000 a year, they are capping it out with just their income here in Utah. And then their property tax is lost in terms of a deduction. So this one's a big one for us. Being able to increase that to $40,000 is going to help a lot of people.
And that one also phases out for income. So that is for those who make less than $500,000 as their modified adjusted gross income.
And it's an itemizer thing only, and it's after the AGI line, so it doesn't impact Social Security as much either. But it does impact your tax return later. It helps you erase some of that income.
That one is not permanent. It is set to phase out after 2029, where it is set to go back down to the $10,000 again, with our asterisk around permanent and temporary phase out conversations that we had earlier.
That's right. Can I throw out just a bunch of different resources that people need to be
Yes.
thinking about? So our videos around how does your tax return get calculated here on this channel. Our previous video on the Social Security tool worksheet talks more about the exact math going into provisional income and the lesser of the two-part calculation and how that is calculated. Your recent video from 2 days ago goes through, I think, fantastic, the bill and like the different aspects of the bill and the ones that in particular hit seniors. Those three are, I would say, are almost like prerequisites for this current tool, but you're welcome to tinker with this one right away. So I've been podcasting for about 6 or 7 years, and it's the Financial Call, and it was on Apple and Spotify, and wasn't smart as you to get on YouTube. So I hopped on YouTube about 3 or 4 months ago, and I'm rebuilding what's called the guided path. So the guided path is like you hit really important topics and what people want to know, and I stupidly don't. I just keep going through in a stubborn order. But however, I do think it's helpful for people. So basically, we take income planning from start to finish in 5 episodes or 6 episodes. And then the season that's coming right now is all about that Roth. So a lot of these Roth conversion strategies and who should convert everything, who should convert nothing, and how to be in the middle. That's 1 episode within the whole Roth season. We're going to hit Social Security after that, which we've done a lot. But then there'll be less crossover when we get into some of the more financial topics around investments and markets and things like that. Estate planning you covered. Anyway, we just hit a bunch of these topics from start to finish is the idea. And of course, happy to help wherever we can.
No, and I'm going to throw up the link to your channel in the description. Please, if you are a subscriber to this channel, you're going to love that channel. So go subscribe to Zacc's because they do it in a little bit different way, a little bit more ordered, because mine have come as the topics come up. But,
yeah, which is good.
Yeah.
And you'll probably have to be patient because we are a little bit long. Like sometimes we go a little long, but we want to give you all the info to help you be the best you can be with your money.
Zacc, this is amazing. If somebody does want to, because I'm the Medicare nerd, I make videos sometimes that dive into these financial topics, but in terms of how all this works together, that's definitely you and your team. So if people do want to use your help, again, we save this for the end. What is the best way they can get in touch with you? Who can use you?
Yeah, someday I will convince you of the level of expertise you really have, but it'll be a while, I can tell. Okay. So,
I can't professionally help people plan their...
that's fair.
Yeah,
you don't have the license for it, but you've got the knowledge for it. Okay, so you talked about your expertise, Medicare. Social Security, really deep analysis, things that most people miss. That's our specialty. Auditing tax returns from a strategic standpoint, not from a did you file this the right way and you missed this little thing here. It's more of audit the return to spot opportunity. We have software for that. We can mock up scenarios. We can throw things together, and that's a specialty of ours. Investing in a way that is more efficient to reduce cost and eliminate layers and bring investment decisions closer to your portfolio. That's a specialty of ours. So we think about all the different components of financial planning and adding on things like insurance analysis. We really don't do a ton of insurance. I think sometimes the best people to do life insurance or annuities for you are the people who don't do life insurance and annuities very often because that means they're not really that interested in trying to sell you a product. It's more of just like, if it's the only thing, we need it. You need some term life insurance. Let's knock it out, and be done. But anyway, so those other things, and then estate planning, and really everything that comes to bring two things closer together: your purposes and your values and your money. If we can get those two things closer together, the strategy of all of this around it is really just to enable that.
Yeah.
And that is the focus. And our job is to be the nerd. Your job is to tell us what matters, and then we bring that together.
If they want to contact you or get in touch with you, we've got your YouTube channel, capitafinancialnetwork.com. The Retirement Nerds, if you reach out to me, I can make that handoff as well. Probably the most difficult question of this entire session is, what is the keyword to show that they have made it this far?
Yeah. I feel like we should be using something around the line or something around
the line
because
works.
of AGI.
If you use the line in your comment, then we'll know you've made it this far. And again, we use that for comment management. The video that went, I think it's safe to say, viral at this point has thousands of comments. And so I try to get to as many as I can. Right now I'm digging out of a little bit of a hole there. But if you use the line, then we at least know you've made it this far to track those comments.
Yeah, I hope it's helpful for people.
You're amazing. Thank you so
Thank you,
much,
Eric.
Zacc.